Listen up, folks. Time could be running out to lock in a historic yield at public.com. But you can lock in a 6% or higher yield with a bond account. Here's the thing. The Federal Reserve just announced a big rate cut, and the plan is for more rate cuts this year and in 2025 as well. That's good news if you're looking to buy a home, but it might not be so good for the interest you earn on your cash. So, if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade bonds, you might want to act fast. The good news, it only takes a couple of minutes to sign up at public.com. And once you lock in your yield, you can earn regular interest payments even as rates decline. Lock in a 6% or higher yield with a bond account at public.com/investing unscripted. But hurry, your yield is not locked in until you invest. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
We're live? Yes, we're live. We've been live for like 12 seconds. Hey, everybody. Happy Friday. Jeff, could we say happy first Friday?
It's a miracle. Here we are on the first Friday doing the show called First Fridays, and it's November 1st. So it's even more exciting.
It's an early Christmas miracle. Yeah. Hey, everybody. Welcome.
I don't know if I would go that far.
Yeah, fair enough. We always do banter a lot on our first Fridays, even when it's the second Fridays. We banter a lot as we get started there. Let me do the official read-in and intro. Welcome, friends. Those of you that are watching us live, those of you that are listening to this through a podcast feed or watching it on YouTube. This is our First Fridays live stream. I see John Gallegos is joining us. I'm Jason Hall, joined as always on our live stream by the voice of the people, Jeff Santoro. Hey, Jeff.
Hey, John. John coming in hot here, insulting your shirt choice, which I respect and like.
We are aligned on the Atlanta Major League Baseball team, but at that point, our alliances tend to kind of veer in very different directions. But nobody's perfect, John. You're not perfect. I'm sorry, John. I'm perfect, John.
You know, while we're just getting rolling here, Jason, and we're waiting for people to hopefully log on and watch us live, we never really had a chance to talk about the end of the baseball season.
That's true.
So
that's true.
This will bore most of our listeners, but indulge us for just a minute here.
Before you get going, I do want to say anybody that listens to our podcast and hasn't listened to the live stream before, it's not going to be all sports. So if you just don't like sports, just skip through. Hit the skip button. You'll be fine.
Yeah. Fast forward 30, 45 seconds. Here's my hot take. And you're a National League East baseball fan, so you might appreciate this.
Right. Yep.
The real World Series this year was the National League Championship Series. Those were the two best teams that were remaining in the playoffs.
Yeah. I mean, my team did lose to the team that lost to the team that won everything.
So did mine.
I know.
But anyway, that's my hot take. That's
okay.
The Dodgers and the Mets were the best two teams remaining in the playoffs. The American League playoffs were a cakewalk. The Yankees aren't that good. And God, it's great to watch them lose.
All right. I got to say this. I'm not going to make any friends here, but how about those classy Yankees fans?
Grabbing on the players. Yeah.
That was something. Yeah. Not just like grabbing onto players, like two, like independently of one another. One grabs Mookie Betts' glove.
Yeah. And
Betts reaches for the guy to pull his hand off of his hand that's holding him, and some other random guy grabs Mookie Betts' hand and pulls it away.
And all of it was long enough where it passes that point of like, I did this out of reaction.
Yeah. Yeah. That's crazy. So that's technically in New York, that was assault.
No, it doesn't.
Yeah, no, it's assault. Like you put your hands on somebody.
No, I agree. Dirty Yankee fans. All right, back to investing.
Yes. Yeah. So I'm not going to welcome Sina Hasuna because Sina's not here because Sina's still in meetings. But Sina will show up, and I will welcome him when he joins us.
Yeah, definitely not in a meeting where he works. All right, we got a question here from John. Let's start off with the question, Jason.
Yep.
John says, "What do you think of Equinor? Is that how you say that company?
Equinor. Yeah, Equinor.
Dropping their special dividend. Do do you and Tyler still dig them? I don't know this company at all, so this is
Yeah,
all
so
new.
Equinor is the Norwegian, I believe it's Norway's state oil and gas company. The country owns, I think, a majority stake. If it's not a majority stake, they're definitely the largest investor. Anyway, it's I own some as well. But massively, massively profitable. Some incredibly low cost production. And they've just been pumping money. Like, and this goes back to kind of around the time when, I mean, the quality of their production, their business has been great for decades. But around the time of the Russia invasion into Ukraine, the sanctions that were put in place on Russian oil and that kind of stuff, like it was just a boon for them, and just started just printing, gushing money. And they've been paying these big, giant special dividends along the way. The part of it, John, is just cash flows are coming down a little bit because oil prices have come down. They're just not realizing as much. So it's just a matter of time. I haven't looked at it the past quarter. So I honestly, I can't speak to the specifics, but still a wonderful, wonderful business. Honestly, I expected the stock price to react a little more positively over the past year or so, and it hasn't been fantastic. So I'm still kind of holding for now. I can't speak for Tyler. I mean, I could, but I'm not going to.
Yeah, he's probably lurking and is waiting for one of us to mention one of the companies we always talk about so he can chat the word drink in the YouTube
no, that's
chat.
true. But I'm not going to mention Brookfield because I don't want Tyler to Brookfield too much.
Yeah, I absolutely will not mention Outset Medical either.
He just passed out. Keep the questions coming. If you're watching us live on YouTube, you see the chat. Send us questions. We'll love to take some questions. We got some planned topics for today too, right, Jeff?
Yeah, we do, but I love ignoring them and answering questions instead. Here's what I had. So I have not spent a lot of time looking at the Mag 7 companies, partially because I no longer own any, but I own one of them still, two of them.
You still own them all. You don't own them.
I'm sorry, I don't own them individually, so I'm not tracking them. I own two of them, but not the rest. But I'm curious if you follow this more than I do. It's your day job. What's your vibe on the Mag 7, right? So that was like the big talk for a while. There was a lot of headlines about, and it was true that they were driving most of the gains that we were seeing in the S&P 500. Few of them have reported. Amazon's reported, Apple, Google, Tesla. I think maybe all of them except NVIDIA. Has Meta reported yet? I don't remember, but regardless,
I think they reported
most of them have. I don't know. Do you have any sense of them as a whole? Are we going to be talking about the Mag 7 for much longer? Do you think the acronym's going to change?
They're still gonna be driving a lot of the conversation because, I mean, Amazon, Microsoft, Alphabet, the hyperscalers with the cloud, right? They're massively important businesses, so they're still going to get substantial talk. Amazon, they talked a lot about their artificial intelligence business, right?
Yeah,
how much it's like just growing at the enormous rates, enough so that this could be like the next AWS bit. Like, maybe that's being overstated, but that's the vibe, right?
Yeah, but I want to pause there because I have a question popped into my head as you were talking. So,
okay,
this is one of the things I'm very curious to see over the next several years, right? We're seeing an incredible amount of AI spending across the board, and it's mostly coming from these massive companies that, let's face it, can afford to be massively wrong. And I think that's what's fascinating. These companies could afford to spend 10x what they actually needed to spend if it turns out that this is a little bit of a bubble, and be fine. Yeah, like that's, I mean, I'm exaggerating a little bit for effect, but I do wonder how much of this is them having a very solid understanding of what the demand is versus, to some degree, overspending so they don't get caught with their pants down, so to speak, because they can afford to be a little bit wrong. What do you think about that? Does that make sense?
Yeah, I don't think that's right though.
Tell me why.
I mean, I think it's maybe partly right, but there's an and to it. So maybe for Meta, I think Meta you can put in that bucket a little bit, right? Because for them, artificial intelligence is driving other revenue things, right?
Well, and they're just taking their metaverse spending and pivoting it to AI.
But
now that they
no, they're still
realize.
spending on the metaverse too, right? They're
Yeah,
spending
but
on
aren't they like kind of changing the language and being like AI averse?
Uh, I mean, the bottom line is that the metaverse AI has been from the beginning really important to it,
Yeah.
to making it work. So I don't know. I mean, I think maybe they're kind of changing the language they're using a little bit, the way they're communicating it. But honestly, I don't think their strategies change that much. But if I think about again Microsoft and the cloud three, the big three for the cloud, they're making a tremendous amount of money from companies that are building AI, right? Generative AI models, because they're using a lot of cloud resources to do that, right? So the compute
Yeah,
that's
but I would
happening.
imagine they're also spending beyond the demand they currently see in
No, of course
anticipation
they
of
are. I
future
mean,
demand.
they're what I'm saying is they are building AI that they're trying to sell. We heard from Microsoft that that process seems like it's not happening as quickly as maybe was anticipated. Maybe less because of weak demand, but more because of constraints around um, bandwidth and data center supply and those sorts of things. But my point is that those companies can afford to kind of lean in more on building for things that they're selling because they have income that's coming in
Right.
for others, right? So that I mean, I think that offsets some of the risk for those three. And I think if I'm Alphabet of those three companies, Alphabet that is certainly I think the one that has the most reason to have to build AI because I think it could be at risk of disruption of its core search product, right? From generative AI.
Yeah,
So I
maybe.
think that's a reality that they're facing. Maybe it's overstated in the near term, but I think in the long term, I mean, it is the thing that is most likely to disrupt search.
Maybe. I think it's interesting. So it does feel like some of the novelty of the consumer facing AI stuff has worn off. And I don't know, it already feels like it's starting to fade from the front of people's minds for the first time since it popped on the scene when ChatGPT 4 came out or whatever that one was 2 Novembers ago. And it does make me wonder that I'm a believer that all of this generative AI stuff is going to end up finding its way into our lives. I just
Yeah.
I wonder if it's going to take much longer for it to be as normal to us as using a smartphone is. And and I wonder if there was some hype on the front end. Like I use ChatGPT occasionally, and I know some people swear by it and use it constantly. But to get to the mass adoption phase where it's as ubiquitous as social media, I don't know. I'm starting to wonder if this first little burst is not going to end up being what it is ultimately, if that makes sense.
Yeah. So I think my response to that is that we're seeing the classic Apple playbook on that. Apple didn't come up with the first personal computer.
Yeah.
Apple didn't have the first smartphone. Apple didn't have the first uh, music player, portable MP3 player. They're when they come to market with a product, it tends to be just better than what's
Well,
out
they're going
there.
to be a good test case, right? So
I think so.
If they're
Yeah.
Apple Intelligence products,
Right.
once they're all rolled out, because it's going to be over the course of this year as iOS updates come out,
Yeah.
if those end up being actually helpful and not neat parlor tricks,
Right.
I think that might prove me wrong and change my opinion a little bit. But
Yep.
I'm still in a wait to see. I mean, I can't do the Apple Intelligence stuff. My phone is too old and I'm not upgrading just for that. But my son's iPhone is new enough, and so is my wife's.
Right.
So he updated the 18.1 or whatever it was that came out this week, and I came home and I was like, "So anything?" He's like, "Yeah, it's nothing." Like, and I know this was just the first one,
Yeah.
so I don't know. It'll just be
So
interesting to see how that plays out.
so here's the way I think about it. For the past couple of years, since Chat GPT became publicly available, and we kind of went through that initial explosion you were talking about, how many times have we heard from pundits and the talking heads that Apple is losing the initiative, they're falling behind, like all of those things. And even you can go further back than that and you can say that Siri had fallen behind Alexa
Well, it
and
had.
Google and like all of those things,
Siri's
right?
pretty terrible.
Well, but my point is my guess is Apple had already made the pivot to building its next generation of technology, and
Maybe.
the AI that's in Apple Intelligence is probably that. So instead of putting resources towards trying to make incremental improvements in Siri, and they've made some improvements, but I mean that's my guess is that it's the classic Apple playbook. I think so. I think you're right. I think it's going to be the test case. But the fact that they have come up with something that quickly, I'm curious to find out if they did something that we usually don't see Apple doing, which is react to the marketplace versus move where they see an opportunity to have the best product and make money. I guess the iPad was probably like the last time we really saw them
React.
react to the market. And that's been a massive success.
Yeah.
So that'll be interesting to me. We got a couple new comments here.
Yeah. So John Dargan's glad to be tuning into the live stream on the first Friday. Yes.
We all are, John.
We finally did it. Actually, we were looking ahead. It looks like the next couple, I don't want to jinx it because one of us could end up taking a weekend trip or something, but looks like we're going to be on a nice first Friday schedule. So let's see how it goes.
You shouldn't have said that out loud.
I know. I jinxed it.
What a mistake. Andrew Hardaway, Athens, Georgia, one of the great towns in our wonderful, wonderful country. Love Athens. I was there for the Mississippi State football game a few weekends ago. So wonderful, wonderful city to go to. Great town.
I'm going to say one more thing about AI before we maybe change topics.
Okay.
This is the anecdotal / what I think would be helpful for AI thing that I hope is in the future, but I don't think is here now. And I'll just give you like a quick example. At work, there's sometimes, just because many people need to know many things that go on where I work, I find myself having to do the same thing in two different spreadsheets, like a shared Google sheet, right? So I change something on one and then I have to change it on another. And it's basically, I'm duplicating the work.
Right.
I want to get to a point where I can like type into or click a button and just say, hey, every time I turn this line on this spreadsheet blue, please also do this other thing on this other spreadsheet. Click. And then like that's the assistant AI smart technology I'm waiting for. And I know that there's ways to like write scripts and formulas in like Excel and stuff to do a lot of those things, but I just want to be able to say it or type it as a sentence what I want to happen, and then I want the AI to do it. So that's the future.
You want a digital assistant that you can just tell to do that sort of thing?
Yeah, because like a lot of my job ends up being just dumb stuff like that. Yeah. And it's fine. It is what it is. Every job has little dumb tasks, right? But I think that's where it could be super helpful. So
yeah, I think so. I think more too. I think one of the things that AI could be really interesting and powerful for, and we talked about this a little bit before, but again, thinking about people that work in the thought economy in some way. Your job is to think about things and make decisions and try to be objective and have a different point of view and leverage your expertise and all that kind of stuff. Humans are not wired to be unbiased, right? We have our biases. And one of the things that generative AI can do is think about things in ways that you can't or won't, that can be really, really useful. So I think that's going to be an interesting thing for me to follow with AI. So,
yeah. Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So, for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. All right, we're going to pivot topics, but we got a couple more comments here. John's asking us if we're planning on going to Omaha in 2025. I will say this. I would love to go back. Jason and I both went 2 years ago in 2023. Ton of fun. We were there to see Charlie Munger's last one, which was cool in retrospect. I'm glad we did that.
Yeah.
It was always a really bad weekend for me because it was always one of my kids' birthdays and another kid's the weekend of his high school musical. But my schedule has changed, and he is no longer on stage that weekend, and my kid's birthday's during the week. So I can go, like, schedule wise. I think I'm going to wait and see, though. Maybe make a decision in the winter or early spring. But it was a lot of fun. I think what makes it fun, Jason, and you can tell me what you think about this. What made it fun for us 2 years ago is that a bunch of people we knew were there.
Yeah.
So it
Definitely.
ended up being a social gathering and a networking event, and not just the two of us going to see. But yeah, if we do go, and anyone's listening or watching and you go, let's absolutely try to meet up and say hi, because meeting people in real life is a lot of fun.
I've been wanting to talk to you about this one, Jeff. So I'm going to talk to you about it here with all of our dozens of other friends that are listening to us. Markel, I think, might be a lot of fun. Tyler went to Markel last year and said it was fantastic. And because it is smaller, there are more opportunities to network and meet people and have fun conversations and interesting conversations with people that you otherwise just wouldn't be able to. So Markel might be an interesting one to think about too.
All right, we'll put that on the list too to think about.
Yeah. Our friend Morgan's on the board there too, so we might run into Morgan.
Yeah. All right. So I have a question for you, Jason. We argued about this on text this week, as we often do when Roku comes up, because I wouldn't say it's in the top tier of my conviction ratings, but I still own it. I still don't want to sell it. And I know you dislike the company a lot more than I do, and you do not own it. But there was news that came out of their earnings this week that you and I both agreed would be kind of fun to talk about. And I'm curious if, for those who are watching live, what they think. So the numbers were what the numbers were. It was actually a pretty standard quarter, I would say, compared to the last couple, still making incremental moves towards profitability. The guidance for the next quarter for adjusted EBITDA was not great. But the big news was they said that they are no longer going to be reporting two of their big metrics. So the three big metrics were always streaming households, streaming hours, and ARPU, average revenue per user. They are no longer going to be reporting streaming households. They are no longer going to be reporting ARPU, because those two are related. And they gave new metrics that they think are the key performance indicators. I think platform revenue, still streaming hours. I forget the others. Now, my first reaction was red flag, big red flag, company not reporting a metric that they always have reported. But then I remembered Netflix did the same thing. And, everyone got upset and the stock dropped. And then I think everyone kind of got over it. And the other thing, when they explained it with the couple sentences they put in the press release, it actually, to me at least, made a little bit of sense. If most of the revenue is coming from America, but they are expanding internationally, it's not the most helpful indicator. The other thing that made me retract my red flag is, while ARPU has been pretty flat for a while, because that was my thought, like, what are they trying to hide, right? ARPU's been pretty flat. It's not like it's been trending in the wrong direction and they don't want to report that anymore. It's been steady. But streaming households has been going up 10, 15, 20% every quarter. So it's not like these were troubled metrics, and they're trying to hide that. So anyway, those are my thoughts. I want to hear your thoughts. I want to see what our listeners think.
So first of all, so we've got a question about SOFI. We will get to that. I saw that came in a second ago. First of all, about this particular topic, I don't dislike Roku. I have a Roku TV. I like it fine.
You just like the stock.
I don't think this is a market beating kind of business. I think it's commoditized. There's too many big competitors that it's not their profit center. It's just part of their ecosystem that are big, big competitors to fight against. And Roku has one thing that they do. Amazon, Apple, they have so many other things that are part of their ecosystem. Convenience is big. So that's why I struggle with Roku. Where I come down on this with KPIs, our next show that's coming out, folks, next Wednesday, listen to it. Great conversation with Emmett Savage, one of the co-founders and the chief investor at My Wall Street. What was the word that he used to describe these? Vanity metrics.
Vanity metrics, yeah.
Yeah,
Great.
I love that. And I always have an issue when a company has spent years touting a metric and then changes it. I always have an issue with that, whatever their justification. I also think it's utter nonsense to compare Netflix to Roku. Netflix was coming off a massively successful quarter and a great period of time when they made those changes. Roku, right? So I'm going to push back on it. I'm also going to say a couple things. The reasoning that they gave about changing it was they're growing in international markets and monetization is different. Okay, you know what you do? Break it out for us. Okay, here's our user growth here's our households in North America. Here's our households in rest of the world. Here's however you want to break it out. Show us the average revenue per user by these markets. You know who does that already? Etsy does that, right? So there is a way that you can still use that and break it apart because yes, we know that EMEA, that part of the world, Southeast Asia, the ARPU is much, much lower.
Yeah.
The monetization models are much, much lower.
Pinterest does it too.
What's that?
Pinterest does it as well.
Pinterest, right. So yeah. The point is that, yes, okay, that's sure. Give your investors a little bit of credit for being slightly sophisticated. And if your average revenue per user is coming down because you're growing your user base at a much higher rate in those lower ARPU markets, okay, that's fine. So I think it's nonsense. And I think it's just more wallpapering over the fact that it's a mediocre business.
I don't disagree with you. In fact, I'm pushing the other side of this just to make the conversation and argument a little bit more fun. So here's what I would say in response to that, though. If I stay on my side of the fence here,
right?
I think it's unrealistic to expect any business to never think it's appropriate to change the KPIs that they report because businesses change and grow. Now, this is not like, I guess to counter what I just said, it's not like this is a company that has tripled in a year and now all of a sudden the metrics when they were a startup are not appropriate because they're a mature business, right? It's not that kind of a thing. So, but I think generally as an argument, I hear what you're saying. I also don't like when KPIs change because I track them over a long period of time. And now I'm like, well, now I can't look back and see. But I also I think it's unrealistic to like paint all companies with the same brush when it comes to like, if you change a KPI, I'm out, right? You're not saying
100% agree.
You're not saying that.
100%.
But here's, I guess what I'd say in defense of my original point is I like watching the KPIs because I think they are an indicator that the financial results, the GAAP reported results that are not there yet will be coming.
Yeah.
But ultimately, I'm going to decide to add to or to sell or to hold Roku, not necessarily because of these metrics, but because I'm seeing them inch towards GAAP profitability or increase the cash that they're generating or even continue to show growth on adjusted EBITDA, which has been, what they have been showing. Now that's trending down for the next quarter, which is part of why the stock sold off. But yeah, I didn't want to compare it to Netflix to say like they're comparable businesses. Like, no, they are absolutely in different places. I just wonder if that gave them the permission structure to feel like they could do it. So yeah.
Yeah, it's a trash stock. You should just sell it. Yeah.
I'm really trying not to, we talked about this. I'm trying not to sell stocks unless I really, really feel like it's a completely broken company. And I don't feel that way with Roku yet. I've not added to it in a very long time and it's a tiny position. It's just sitting there. So I'll watch how it goes. All right. let's get back into the. We'll come back to SoFi earnings, but Jay Gatsby says it was fun meeting us at Full Fest. Absolutely.
We
Now
had
I
a
know
blast.
who
It was
that.
nice having a burger with you,
That's
having
right.
some wonderful, wonderful stories. Eventually, we'll wander over to Maryland and have a cocktail at the bar you run there. That'll be
Teo says he gave up on Roku a while back. He says, I just don't get it. I think there's better opportunities in digital ad space. I agree there. Like I said, it's not top of my list. I just don't want to sell it yet. Teo wants to talk about Lemonade. Lemonade had a good report. Now they just need to not have a disastrous gross loss ratio the next quarter like they usually do after good news. And John says, Jason, I heard that you avoid investing in tobacco stocks even though they have reliable high yields. I got past the ick factor by thinking I am taking their money, not giving them mine. So let's come back to that one, Jason. I think that'll be a fun conversation. Let's talk about SoFi because you follow that company pretty closely. What did you think about their earnings?
they're ahead of schedule. I mean, that's as simple as it gets. They were talking about trying to get to just kind of a little bit of GAAP profitability this year. They were GAAP profitable, I believe, in the second quarter, third quarter. They beat expectations. They beat their own guidance, which I think is good. They raised their full year guidance. I mean, everything just seems like it's kind of the playbook. They're executing their playbook, I think is the best way to put it. One of the things that was really impressive to me is like their fintech business that they do. So they became a bank. So there's been a lot of focus, like looking at like their lending business and growing deposits and all that kind of stuff, like the typical banky stuff. But their services-based stuff and their fintech tech platform is doing really well. And it's generating strong results, like up, I don't know, 40% last quarter, really good. And I think it makes up like half of revenue now. So, so the business, both sides, the banking side, and all the like the financial services stuff it's all going really well. And the transition to profitability is ahead of schedule. So wonderful. I think the biggest, obviously it's still a bank. So there's leverage risk, there's economic downturn risk, like all of that stuff comes along with it. But probably the thing that I'm most concerned about destroying shareholder value continues to be dilution because they issue equity like a tech company. So that dilution's eroding value, but again, they're ahead of schedule on earnings per share. So, they're doing a lot to kind of help make up for that. So yeah, pretty happy with what I saw there.
All right, let's talk tobacco stocks because we debated this recently on an episode. I think it might have been a mailbag question, and we talked about how my thoughts on this have evolved. Like I no longer have never stocks. Like there's are never industries, but because I like to root for the companies that I invest in, I just have no interest in rooting for a tobacco company. And I get that they're competitively advantaged. There's high barriers to entry. Like basically no one can come in and compete with them.
Right.
So I get all that. Here's my question though. We have not talked about this. So I'm curious this is just a thought I have. I don't know if it's backed up by any data. I wonder if so smoking is decreasing year over year is my understanding. Like every year, less and less people are smoking. And these companies are now pivoting to other products that have tobacco in them and are still addictive, but not nearly as. I'm curious to see if and when cannabis becomes either rescheduled or just federally legal. And I know some of these companies have already invested poorly in cannabis companies.
Oh yeah, no,
but I do wonder once it's like all of the barriers to making those businesses better are down, like you can actually go to a bank and get a loan and all that stuff. Do these companies just start gobbling up cannabis companies?
No, maybe. I don't know.
Yeah, just a thought I had.
Yeah, I mean, I've thought about that before, and I'm not convinced that that's going to happen. Because a lot of them have already kind of lost their shirts trying to do that, and it hasn't gone well so far. And part of it's again, we talked about the legal aspects of it. My concern is that when we do see eventually the federal laws change and it's either decriminalized completely or just made legal, no longer banned, or no longer listed as a controlled substance, that there's just going to be such a land grab that there's no money to be made that makes sense for these companies that have massively profitable businesses that are just steadily in decline to try to make that transition, right? Or to make those acquisitions. So that's my one thing, is that generally they've been pretty prudently run, because the people that run them know, like, this is, we have massive cash margins. The best two things we can do is pay dividends and buy back stock. Let's just keep doing that. So we'll see. We'll see what happens. For me, it's just, it's less ick, and it's very, John, very personal. Tobacco killed both of my grandfathers. One from emphysema, one from lung cancer. My dad has emphysema. So yeah, I have no interest in taking their money either. I won't fault anybody else that does at all. My dad has emphysema, owns at least one tobacco stock, and his justification is the same thing. He's like, I gave them a lot of money. They took my health. I'm going to take their money back.
Yeah.
So,
and there's the other side of it too. Like, you could take all those dividends and donate to the American Cancer Society. Like, you can turn their money into good if you want. So to each their own. Neither of us would fault anyone for making a different decision.
No, John, again, John Gallegos is with you there. He's owns British Tobacco, Altria, TPB. I can't remember which one that is. So great dividend, great long-term total return profiles. Definitely. Look at that. Colin Waugh, our good friend from northwest of the border, has joined us, and I think so far he's ahead on the comment battle, right?
Yeah, I don't know that he says, whiskey in hand, 2 cubes, 1 for each of the handsome tall drinks of lemonade hosting.
So wonderful.
Such a wordsmith, our friend Colin.
Love you, Colin.
All right, I want to. Jay Gatsby's got a comment here, asking us if we've ever looked into Rocket Lab or Transmedics, and that he and I talked back at Full Fest about. I was interested in Transmedics. He heard the call and bought the dip. So actually, of the two companies, I have Rocket Lab on my watch list right now. I never looked into Transmedics beyond just I like the story of it, and I think I'm a little bit burnt by Outset Medical, just in case Tyler's watching. I'm trying not to get sucked back into a feel good medical stock. Like, I love what Transmedic does. I'm just
they make money.
Yeah, I know. I'm just I haven't looked that closely into it. I'm trying to whittle down my stock portfolio, not add to it. So I'm being very judicious and slow in my but I've also, just to kind of completely contradict what I just said, have also been more interested in picking up some starter positions in some of the companies I'm interested in, just so I follow them. So I wouldn't be surprised if I at some point bought a little Transmedics. The Rocket Lab one, I'm a little more interested right now. And my thesis is basically, and this is not a political or a statement about Elon Musk necessarily, but my basic thesis is we need some other private company other than SpaceX to launch stuff into space. Like, that's kind of my starting point thesis. So I think both of those are interesting, and one that I do intend to look more into.
So I'll take Rocket Lab first, and then I'll circle back around to Transmedics. So I like Rocket Lab, and it's very high on my list of companies to buy a starter position in. It's one that Lou Whiteman and I have talked about. And if you go over to the Motley Fool's YouTube channel, it's youtube.com/@Motley Fool. Lou and I did a scoreboard. It's like a back and forth kind of bull bear. 2 analysts rate the company over a series of different categories. We did that for members months and months ago, but they put it out for free on the YouTube channel like a day or so ago. So go check. It's like a 10 or 12 minute video. Go check it out. Lou knows a ton about aerospace.
Yeah. His commentary on the company is one of the reasons it's moved up to the top of my, what's the word? Watch list.
There you go.
It
That's
is.
It. Something he said really stood out to me. You mentioned, and this is what reminded me of it, Jeff, talking about Musk and SpaceX. One of the things about SpaceX is, what's the satellites? Starlink. That's one of the other Musk companies. Starlink sends a lot of business to SpaceX. So you've got interrelated party transactions that are happening, right? Rocket Lab doesn't have that, right?
Right.
They're having to live completely on their own merits. They're not being fed by another entity owned by the same owner. So that's a differentiator that Lou brought up. It's like they're doing it on their own.
And isn't their strategy a little bit different? And
It
tell me
is.
if I'm wrong. Like they're trying to Rocket Lab is trying to focus on smaller stuff,
Well, smaller is
right?
better, right? And it's
Yeah.
not completely that, but because the bottom line is like
Or that's where they started.
it's orders of magnitude. The heavier something gets to go to space, the more thrust you need, the more fuel you need, the more fuel you have, the more fuel you need to lift the fuel, to lift the rocket, to lift the payload, right? It's like it's a massively compounding thing. So they've taken an interesting approach to try to do lots of small launches, and it's been very successful. But they are going with some kind of larger things that they're doing too. Wonderful business. They got great people running it that understand space and rocketry. So it's interesting. So go check that out on the Motley Fool's YouTube page.
Hey, everybody, we'll be right back, but first, a word from our sponsors. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/investing unscripted. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
What's the other one?
Transmedics. Now, Tejo's got a comment here that I think is tied to the conversation, which is the Transmedic plane business could be a massive failure. And that is something that's given me
a big
pause.
risk.
I don't know what to think about it. Like I on one hand, I get it. It's logical, right? Let's buy the plane so that we can get the organs to people quickly and not have to worry about other people's planes. But I also know that that's a big expenditure and adds a layer of risk to the company. But it's one of those ones where I don't know how to feel about it.
Yeah. So one of the reasons I've been slow to invest here is I have a personal relationship with, their headquarters is like 10 minutes from my house, Transmedics. I'm good friends with, somebody that's reasonably high. I don't want to say much more than that, but let's just say it's a high level employee at the company. So I've tried to be mindful of not letting, that personal relationship and my natural inclination to be, I'm a positive person, right? But I will tell you, the people that work there, they have purpose-driven work.
Yeah.
They're all I've talked to a lot of people. They are very, very driven by the good that business is doing. And literally more people get to live because that business exists. And that is powerful to me. And they're doing pretty well. The stock got hammered. It's definitely moved higher up my list because of that. You go back earlier in the spring, that a massively successful quarter in the stock skyrocketed. It's basically given back, I think, just basically all of those gains at this point. So I'm going to take a closer look at the results. But yeah, their move to add, invest a lot of capital and leverage to own the planes is smart, but certainly comes with some risk.
I want to address Colin's question about why I don't grow my beard out. Because Colin needs to know I did this at one point in my life, and it's not a good look. And I don't know how old Colin is. He may not be old enough to get this reference, but I look like G.I. Joe. Like that really, like my beard won't grow out. Like I can't get like a ZZ Top length. It just like stays tight to my face and just it's a bad look. I understand Colin's got a nice manly beard, and that I wish
He does.
that
got a
could be
real
me,
beard.
but it's not
He's a
it's not in the
manly
cards
man
for
beard.
me.
John Dargan, thank you for your kind words. I appreciate that. I don't think you took it this way at all, but definitely don't think I was trying to guilt anybody at all. I fault nobody for doing that, but thank you. I appreciate that. Andrew Hardaway just started a position in Rocket Labs. I need to follow you here pretty soon. I think it's time, Jeff.
Time for what?
We need to join our members. Open a Rocket Lab position.
Yeah. That's it. We've made our decision based on YouTube comments.
Well, I mean, our savvy trader. I'm buying in November.
That's true.
We haven't bought. I'm going to say it right here. We haven't bought Rocket Lab and the Savvy Trader.
Yeah. That'll be the one thing we give away about the Savvy Trader portfolio is we have not bought Rocket Lab in it. Although if anyone paid attention, they would know that, because I think we did say that our goal is to never buy something in that portfolio that we don't personally
that we
own,
don't own.
So.
Right. Yeah. Okay, shameless plug. I'm gonna do it. Here it goes. We're 6 months in. Let's have this conversation. So we're 6 months in. This is Savvy Trader Portfolios, the green line. It's been up and down. We're up about 18% over since we started it 6 months ago. We're up about 18% over the past 3 months too. A lot of volatility, but early results are positive.
Yeah, I'm not ready to claim victory, but I'd rather be ahead than behind after the first 6 months or so. It is interesting. The fun thing about that is how differently we approach those decisions than like the portfolio contests. Like we're actually like being a little bit more judicious and careful, which I think makes sense because we're trying to pattern some of the same decisions we make in our own portfolios. So
yeah. Any other observations you have about it 6 months into it? I don't want to make this like a total advertisement for it, but
it basically already is. No, the reason I like it is because we don't want the podcast or the Friday shows to be the first Friday shows to be all stock talk. That's not our vibe. That's not our wheelhouse. I think if we have any value to listeners, it's the conversations, the question asking, the wrestling with tough aspects of being an investor.
Yeah.
But we do also like to talk about stocks because it's just fun for us. So it gives us an opportunity to do that in a different setting for people who choose to come and subscribe and check it out. And we try to model all of the toolbox stuff that we do talk about on the podcast in like not a real money, right? Because it's not, but
it's a notional portfolio.
But if we were to like start a portfolio together, right, in real life, like this is basically, I think, the process we would use. So if anyone wants to check it out, savvytrader.com, look up Investing Unscripted, you can subscribe.
Yeah. So we put in the newsletter. I'll try to remember and put it in the description for this, for the podcast.
It's in the description of every show. It's in every podcast.
But the key is this is what we do. And we're taking $1,000 every month and we're investing it into either a new stock to that portfolio that that we already personally own. We've started doing some reinvesting in stocks that we already own in there as well. But like you said, we're just really trying to apply those things. It's savvytrader.com/investing unscripted, I believe. Check it out. It costs money. We get most of the money. So it's like giving money to us.
Although we are donating it to charity too. So there's a charity component, which you can read about it.
Some. Not all.
All right.
Jay Gatsky, it's Neutron. That's the medium launch rocket that they're coming out next year.
Yeah. Follow up on the beard comment. Teo says, at least you don't look like the Unabomber. Here's the problem. When I had it grown out, I kind of did. All right. And Andrew Hardaway says the Chit Chat Bros did a deep dive on, I don't know which one he's referring to. They might have done a deep dive.
Rocket Lab.
Oh, Rocket Lab. Yeah, they did.
Yeah.
Rocket Lab. A plug for them. Talking about like what I just said about how we don't want to make our podcast into stock talk. The reason is that there's great podcasts out there like Chit Chat Stocks that do a great job at that. You should all check them out. All right, let's.
So who, what, where through an Outset Medical? I don't know if he was asking a question or just getting Tyler Crow to drink more.
Yeah, I hope it's both, but I have nothing to say about that company right now.
Either. Yeah.
All right, let's stick with earnings though. So
Okay.
we are in earnings season, kind of maybe not quite into like the deepest part of it, but certainly where there's multiple companies every day that you and I keep an eye on. Um, I don't have any super insightful hot takes. I feel like a lot of the companies I follow, they've just been kind of like regular quarters, and I think that happens sometimes where it's just
Yeah.
you look at the results and you're like, yep, this is kind of what I was expecting. No big surprises, no huge 20% drops or pops. Um, I One that we both follow that did have a decent pop though, and you had some questions or concerns the night that they reported, if I remember, which is Lemonade, and I think someone actually mentioned it in the comments a few minutes ago.
Yep.
To me, it looked like good quarter. Things still heading in the right direction. Um, Loss ratio up a little bit sequentially, or the combined ratio up a little bit sequentially, but still down year over year.
Combined ratio, but the gross loss ratio was improved.
Yeah.
Maybe the
Well,
best it's been as a public company.
and in the wheel and competitive, right? That's kind of the thing I try to keep in my mind. Like,
Yeah.
I want them in the range of like the other companies out there that do insurance.
Right.
But what was your take on Lemonade? What were the things that did
so
pop
this
out
is-
as concerns?
This is my cynical take, but then I'll give like the full take. And this will only take a minute. I'll be pretty quick on this one. But my cynical take is I've spent 2 years saying, you guys have kind of figured out the operational stuff really well. If you could just underwrite insurance, it'd be awesome. And now it's like, really good job figuring out how to underwrite insurance.
If you could just run the business.
Why the hell are your operating expenses going up so much? And so a couple things, like they just last quarter, they started talking about that net cash flow metric, which is, so insurance companies are weird, right? They recognize revenue as the insurance policy goes out. So you write a policy for 12 months and you collect $1,200. Every month you can recognize $100, right? As the policy goes out. So on your books, you carry a liability for the policy that you haven't, for premiums, you unearned premiums, right? You have the cash, right? You have the cash, but you can't recognize the revenue, so you carry that liability because if the customer cancels the policy, you have to give some of that money back, right? So that's how the books offset. So I was looking at their books, and they've been talking about this net cash flow thing for a couple of quarters now. And I didn't go back yet and look at like the quarter over quarter changes, but like looking at their balance sheet, their assets are up like $200 million. These are round numbers. I've got a video that's going to come out on our YouTube channel sometime over the weekend looking at it. Like it's about a 10-minute video, but the round numbers, assets went up about $200 million since the beginning of the year. So 3 quarters of the year. Liabilities are up $300 million. So they're collecting all that cash, but they're depleting it. Now, I looked at their spending by different buckets, and essentially that $100 million difference over the year is the increase in sales and marketing expense. So, and they told us earlier this year, we're shifting back to growth mode. They bought Metro Mile, and they're like, okay, we're going to be a little more disciplined with growth. They pull back a little bit. And then earlier this year, they're like, okay, we're going to accelerate growth again. And they're doing it. They're doing it, right? So seeing those lower expense ratios, the gross loss ratio, like, okay, the underwriting looks good. And then the thing that's gone up on their operating expenses, the thing that they said this is going to go up because we're trying to accelerate growth, I'm kind of okay with it, right? And my guess is if I look at this quarter, from the beginning of the quarter to the end of the quarter, look at their balance sheet, that net cash flow thing is probably going to balance out pretty good. And they will have ended the quarter with more cash than they started, like the more assets than liabilities. I want to look at that and see like, how does the whole thing carry out through the books? And if it's pretty neutral, then I would be happy with that.
Yeah. I didn't get a chance to read I just kind of put the numbers into my spreadsheet just because this was a busy week with earnings and stuff.
Yeah.
But the thing that I'm looking at right now unless I have my numbers wrong, but pretty sure they're right, I like to track operating expenses, total operating expenses, just as a percentage of revenue.
Yep.
Right. So this quarter that just ended, 148%, because they're still losing money or not profitable. But September 23, 151%. September of 22, 220%.
Yeah.
Right. So still you don't want that
still
to be
too
anywhere
big.
near. Yeah, it's still too big, but like,
But it's less too big. It's less
yeah.
worse.
And
Yeah.
there's sequential increases here and there, but I'm always kind of looking at
Yeah.
the year-over-year numbers because I feel like that's the kind of business where you do want to compare year-over-year because
Right.
storms are typically in certain parts of the year in certain parts of the country and things like
Right.
that. So,
Yep.
yeah, to me, they're fine. This is one of those companies that I hope in 25 years is like a Progressive.
Yeah. Yeah.
But
Right.
and
Or
I'm
like a
kind of just
State
waiting.
Farm
Like
or
I don't expect
no,
this to
yeah.
be something that's a winning stock 5 years from now, or
Right.
so it's a
They're
long-term hold
doing
for
the
me.
things to me that are giving me the conviction to continue to give them more time to keep doing it.
Yeah.
That's kind of where I stand. Yeah.
Yeah. All right. Any other, oh, all right, we got some comments here. Let me go. Just went back and looked. Teo saying it's funny. Stocks can always go down. My Outset Medical position is -70. Good. I could barely get a Big Mac combo with the cost basis. I'm glad he said that because that is a fun thing that I've learned about the math of investing just through Outset, which is it's incredible how a stock can go down 80% and then go down another 80%. And then
Right.
go down another 80%.
Yeah.
Like just the way the math
Yeah.
works. Yeah, learn that lesson with Outset for sure.
Jay
Right.
Gatsby, odds limited would get bought out. I think it's very, very low. Yeah. Very, very low. Yeah. I don't think there's any reason for anybody to buy it. And the insiders have enough controlling votes that I don't think they're ready to walk away. So I think it's very low. Yeah.
Yeah, and if they really believe in what they say their company was founded to do, which is disrupt the insurance industry by being a app first, AI driven, quick response, friendly, positive insurance experience.
Right.
Anyone watching this who is old enough to have ever dealt with insurance knows that at best it's annoying. And
Right.
at worst it can be infuriating.
Yeah.
So if they can really become a profitable, successful business where you can open up an app and in 90 seconds get a quote or a claim taken care of, you could lock in a generation of customers that will never go back to deal with a Geico
Yeah.
because it'll feel like an antiquated model of what they're used to. So
Yeah. No, I think that's right.
that's aspirational, and I hope they get there. But I think I guess my point is, and who knows what happens if they really struggle. But if I'm the owner of that business and I really believe that, I'm not selling to Allstate.
Yeah, I mean, their entire book of insurance business is still less than $1 billion, right? What's
Yeah.
the technology worth? So, it's hard to imagine that getting acquired. So, all right, real quick here, I want to talk about Confluent just really briefly. Companies that reported that, the quarter we just saw and the reaction the market had was completely unsurprising to me. The stock was up almost 20%. I think it closed up 15 or 17%. After earnings. And the earnings were not extraordinarily good. They were just what I expected. They beat expectations. And I think they probably shook some shorts out of the stock. But the playbook is continuing to execute, moving closer to positive cash flow, getting adjusted earnings and adjusted operating income moving closer to positive. We know dilution's still an issue. They have a plan to address that, like this, as things play out. I still think it's just an underappreciated business. So
it does seem like if you can find a company where if you look at like the net income and or the free cash flow chart, and it's going from big loss to smaller loss to smaller loss to smaller loss to smaller loss over a long period of time.
Well, they went from pre-IPO to we got a bunch of money, let's spend it, big loss, smaller loss, break even. Like that's how.
No, that's what I'm saying.
Happened.
Like when you can find a company that is trending towards and or about to flip over into hopefully permanent profitabilit and positive.
But the
cash
market
generation.
hasn't figured it out, or
yes,
or it's going through the I can't remember what the curve is. What is it called? I'm drawing a blank. It's like the trough of disillusionment, and what is that called? That
Oh, the hype cycle?
Yeah, the hype cycle, right?
Yeah.
So that's where it is. It's been on the hype cycle. It's been in the trough of disillusionment for most of the past year.
Right.
And a lot of that was coming from the pandemic crash, right? All these cloud SaaS stocks crashed, but that business just kept getting better. So anyway, that's all I wanted to say. We've only got a few more minutes.
Yeah. All right. Let's dive back into the comments here, see if we can find anything else here that we want to chat about. Thinking of that's from Andrew Hardaway. Thinking of selling out of Square and or OKTA
It's fine.
due to slowing revenue growth. Have held both for years. Thoughts?
Square's trash. I don't like Block. I sold a long time ago. The business has pivoted. I have almost no faith. I have no faith in Jack Dorsey as an effective leader. He's all over the map. The business has grown enormously and has grown the share count even more. None of the value that's been created has flown through the individual investors who've held.
Yeah.
It's all flown through to employees and executives.
I used to own Square. I bought Square and PayPal, I think at the same time when I was a baby investor. And it was one of those, like, I've heard of them. And I ended up keeping PayPal and ditching Square for a lot of the reasons you just said. Jack Dorsey, scatterbrained, like interested in different things, like way too into crypto for me. Didn't they buy that streaming service that Jay-Z owned? You know, like I don't know. Decisions I just could not understand.
Yeah.
And I haven't really followed it since. I'm happy I stuck with PayPal. I feel like they're turning things around nicely with their new leadership. I don't follow OKTA at all. I guess here's how I would answer Andrew's question. I don't know that I would sell them simply because of slowing revenue growth. Like that's how he framed the question, due to slowing revenue growth, unless I really felt like that was the key thing I was watching. I guess my question would be, what are the other KPIs you're keeping an eye on with that company? Jason, I like your choice here, switching to a artistic camera angle.
So this has happened. This is 2 recordings in a row that this has happened, where my camera has just stopped working and has flipped over to the other camera on my computer. So
it was actually better when it was just blank. So I don't know if you want to consider.
I'm sure. It's interesting that you mentioned that, because
let's go there. In our last couple minutes, we have to address this.
Yeah. We got some feedback from a viewer on YouTube. I want to say I appreciate the feedback very much. I can't remember. Was it Joe?
I don't remember the name.
I can't remember
I have to
the
go back
name
and
of the viewer. So first of all, thank you for being a listener and a viewer. Thank you for engaging us. Thank you for giving us the feedback. The problem is that we are sophomoric. We are. And Jeff, I don't know if I could do this podcast if I couldn't insult you. Like, I don't know if I could do it.
So in the 2.5 years we've done this, we've gotten 2 comments. One was that one you just mentioned. We got an email earlier in our history, basically saying, you guys make fun of each other too much and I don't like it. And that's perfectly fair. The us busting
That's
on each
normal,
other,
decent human.
Yep.
You are a good person.
Better than both of us.
Yes.
But our whole vibe here is we like to have fun doing this podcast because we don't want it to feel like work. It is not either of our primary jobs, and we enjoy it. And like you said, at least half the fun. If
we did an episode, Jeff, and I didn't insult you, you would probably call me the next day to ask if I had cancer or something.
Right? What's wrong?
Right.
What's wrong with Jason?
Yeah. Yeah.
But no, he also said we were a little.
Thank you for caring about us, and thank you for raising that to our attention. But we're probably not going to take your very good advice.
No. And I would also say this, if it makes anyone feel any better, we make fun of each other. It comes from a good place. We are friends.
Does it?
No.
Yes, it does.
Me. I hate your
guts. I will say this live. Jeff Santoro, I love you, buddy. I do.
Oh, I love you too, man.
There you go.
This has been a sweet moment.
Even though you're a terrible, terrible stock picker.
Yeah.
But you're better than me if you look at our contest. We'll get an update. We'll get an update on the contest, but not today because we don't have time today.
All right. Yeah. I'm glad that we had a chance to cover that here. And we're getting some comments here. So high level banter is not our, someone said that. I don't know that anything we do is high level. But the banter for sure.
Yeah. So, Andrew, you're right. Concerned he can't run a more GAAP profitable business. Yeah, no, that's typical. Lots of adjusted stuff from companies that Jack runs. So,
Yeah.
not
All right.
surprised there.
Well, we just told each other we love each other, and we're just rambling here. So we should probably just wrap this thing up.
Yeah, it's getting awkward. You know who else I love? Jeff Santoro.
Our listeners.
Yeah. I like them. No, I love them. Love every one of you. Every single one of you. Appreciate you guys. Thank you very much for joining us. We are going to sign off, as always, in the way that we sign off, which is to remind you, these are our answers. We love to give our answers, even when they're terrible, but they're not. They're great, even when they are terrible. But they're not yours. You got to come up with your own. You can absolutely do it, each and every one of you. You can do it because we love you and we believe in you. All right, Jeff, we'll see you next time.
See you next time. Thanks, everybody.